Hey everybody, welcome to the mortgage market. I'm Derek LeVay. I wanted to take some time this week to talk about rates since we've had a lot go on in the past couple weeks, and I wanted to use a chart to kind of help illustrate my point. So when the stock market does well, people leave the security of the bond, and when the bond sells for less, rates go up. I've talked about this in other videos, and if you see here, the stock market was doing well, so the rates were steadily increasing. You're talking about being in the 4% area here to being 4.5%, maybe a little higher depending on, credit scores, loan to value, stuff like that. Now, the Fed has come out and said they were going to raise interest rates. And as I've said in videos before, them raising those rates doesn't really affect the mortgage rates. It affects the overall market, which could in turn affect mortgage rates. And if you see here on the chart, pretty much at our peak, that's when the Fed said they were going to raise their rates, okay? Now, they said they were going to raise rates, and we've already had a rate raise. What happened is all the major players in the market, hedge fund people, people who control 401ks for large companies, said, we've already had one interest rate raise, and now we're going to have another. They're not so sure if the consumer confidence is going to be there and they're going to be able to handle these higher rates for credit cards and personal loans and car loans. So in order to be safe, we're going to pull out of the stock market a little bit. And as you've known, the stock market was at 21,000. Now it's just under. And they're going to go back to the safety of the bond. Now, when they go back to the safety, they're buying the bond, which means the price of the bond is higher, which is then pushing the interest rates lower. So you have from here to here a retracement in rates back down to the 4.1, 4.2 percentage rate area. Now, depending on the size of the loan, that difference in the rate could be $30,000 or more in interest. And then as far as buying power, it could probably be a $25,000 to $40,000 difference in the list price, depending on taxes and other little compensating factors. Now, why this is important to show everybody is obviously you can't time the market. But this chart here is basically a 1 month spread. Now, you have your highs and your lows, and now we're coming into a low spot. If you see here, we've had a little bit of a flattening off in the rate decrease, and that's because the major move has already happened, and now we're just going to play a little waiting game to see. Are we going to go up? Are we going to come back down? It's really going to depend on what happens in the next couple of weeks. As always, we try to keep these videos short, so please like and subscribe if you enjoy them, and if you have any topics that you want to talk about, feel free to comment and I will do a video on that topic. Again, this is the mortgage market and I'm Derek LeVay. Thanks, and I'll see you next time.